Nobody at the Federal Reserve, at Goldman Sachs, or at Citigroup agrees right now on what the labor market is actually telling us. And if you own silver, that disagreement is the most important thing happening in your portfolio this week. Some economists at Citigroup are calling for 3 separate rate cuts between now and January of 2027. Other desks are still cautious, watching wage growth and services inflation for signs the Fed cannot move as fast as the market wants it to. That split matters because silver does not trade on vibes. It trades on the price of money. And right now, the price of money is the single most contested question in macro finance. By the time we finish this analysis, you will understand exactly why that disagreement is showing up in the silver chart in real time. Let's ground this in the actual tape. As of the close on Thursday, August 6th, silver spot sat at $62.26 an ounce, within reach of a 7-week high. That move followed a July jobs report released Friday, August 1st, that came in soft. Non-farm payrolls rose by just 73,000 against a consensus call near 104,000, and the Bureau of Labor Statistics simultaneously cut 258,000 jobs from the May and June prints. The unemployment rate ticked up to 4.2%. And on a year-over-year basis, silver is now running more than 60% higher than it was trading 12 months ago, according to Trading Economics commodity data. Layer on top of that, a geopolitical variable. Tension around the Strait of Hormuz has been easing after weeks of pressure on oil shipping routes. And that combination, weak labor data plus a cooling energy risk premium, is exactly the kind of cross-current that moves precious metals fast. Here's why that jobs number did what it did to the silver price. And this only makes sense once you understand the mechanism underneath it. Silver, like gold, pays you nothing while you hold it. No coupon, no dividend. So the entire investment case for owning it is a function of what you give up by not holding something that does pay you, primarily short-term Treasury yields. When a jobs report comes in weak, the market immediately raises the odds that the Federal Reserve cuts its policy rate sooner. And right now, the Fed's target range sits at 3.5% to 3.75%, following the July 28th and 29th meeting where they held steady. Think of the Fed funds rate as the valve on a pressure system. When the valve is open wide, capital flows toward yield-bearing assets and away from silver. When traders start pricing in a valve that is about to close, that opportunity cost drops, and capital that was sitting in short duration. Treasury starts looking for somewhere else to go. Before we get to the consequence, we need to understand the cause. And the cause here is not the jobs number itself. It is what the jobs number implies about the September FOMC meeting on the 15th and 16th. Once you see silver as a bet on the direction of real interest rates rather than a bet on fear, the entire move of the last few sessions stops looking random and starts looking mechanical. Now here is what most coverage of this jobs report is getting wrong, or at least skipping past. The headline number, 73,000 jobs, is not actually the story. The 258,000 jobs erased from the prior 2 months is the story, because revisions of that size tell you the labor market was already weaker than the market believed in real time. Citi economist Veronica Clark flagged exactly this dynamic, arguing the labor market may still get described as stable in the official language for now, but that framing is likely to change within months as participation continues falling and the unemployment rate pushes above 4.5%. That is a meaningfully more bearish read on the economy than a single soft print suggests, and it is the difference between traders pricing in one cautious cut and traders pricing in a genuine easing cycle, which is a very different environment for silver. If you are finding this kind of read useful, the way to stay ahead of the next data point rather than reacting to it after the headlines catch up is to subscribe to this channel, because we track these releases and their second-order effects as they happen, not after the narrative has already been set. This is not a channel built around calling tops or bottoms. It is built around understanding the mechanism well enough that you're not surprised by the next move. If that is useful to you, staying subscribed means you see the next read on this before the price has already made the decision for you. Now I want you to sit with something for a moment, and I'm not going to tell you which category you fall into. There is a version of you holding silver right now who could explain, in one sentence, the specific economic condition that would prove your thesis wrong. A rate hiking cycle resuming, a sudden collapse in industrial demand from solar and data center build-out, a real yield spike that makes cash competitive again. And there is a version of you holding silver simply because it has gone up, who has not defined a single condition under which they would sell, and who is quietly hoping the next candle is green because the alternative is uncomfortable to think about. Those two people can own the exact same position size at the exact same cost basis, and they are not taking the same risk because one of them has a plan and the other has a hope, and markets are extremely good at finding the difference between the two eventually. That is not a judgment. It is just worth knowing which one you are before the next data print, not after it. From here, two paths are doing the work. In the first scenario, the July CPI print lands Wednesday, August 12th, softer than expected, reinforcing the disinflation narrative, and the market moves toward pricing a near certain cut at the September 16th FOMC decision. In that world, real yields keep compressing, and silver has a plausible path toward the $65 to $68 zone into September as investment demand builds ahead of the meeting. In the second scenario, that same CPI report surprises to the upside on services or shelter costs, and the Fed's inflation mandate collides directly with its employment mandate, forcing chair officials into a more cautious tone at the September meeting. In that world, silver likely gives back part of its recent gain and tests support in the $55 to $58 range, while the market resets its rate cut expectations. There is a third variable sitting underneath both of these. If the Strait of Hormuz situation fully resolves in the coming weeks, some of the safe haven premium currently built into precious metals could unwind independent of what the Fed does, which is why this is not a simple two-path story. We will not know which of these paths the market chooses until the data actually prints. The CPI release on the 12th and the Fed decision on the 16th are the two dates that matter most between now and the end of September, and this channel will be tracking both as they land. So here's the question I actually want you to sit with. Not what price silver hits next month, but this. When the data eventually resolves this contradiction one way or the other, will you have been holding a position built on understanding, or a position built on hope that happened to be pointed in the right direction? Leave your answer in the comments. I read every one of them, and the conversation those answers generate is genuinely one of the most useful parts of running this channel. This is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk.